Hi guys, welcome back. So, I think a lot of people share the same question these days. When will our growth stocks grow? Because during the whole correction ever since mid-February, we have been seeing our growth stock falling with Nasdaq quite hard. And we took it as a sector rotation, right? So that's why we see Nasdaq beaten down over and over again for quite some time. While on the other hand, we see the complete opposite view from Dow Jones and S&P 500, making all-time highs most of the days. So we were waiting for the sector rotation to finish so then the capital can flow back in the tech stock, right? But the worst thing is, we have been seeing the Nasdaq going uptrend every day, opening with a gap up a few times already, and yet our portfolio is not growing strong with Nasdaq. We might share a very similar feeling because before the correction, our portfolio would follow more closely with the Nasdaq. But recently, it seems like our portfolio is quite detached from the index now. And more people are getting frustrated because we have been waiting for Nasdaq to grow back up to gain back the momentum. And now that it did, but it didn't benefit our portfolio. So today I want to talk about why this happened, and then we would discuss when should we expect our growth stocks to finally get up and follow the trend of the market. First of all, why is the Nasdaq growing so strong and it doesn't affect our growth stocks, our tech stocks? Well, it's mainly because what had been pulling up the index would be mostly the FANG stocks. So we can see stocks like Facebook have been growing very well recently. It's basically gone parabolic after breaking out of this consolidation for a few months. Same with Google going strong, but Apple and Amazon have not broken out this consolidation yet. Even though it has been growing well for a few days, it has not broken the previous all-time high. So it's still considered consolidating and can come back down and backtest anytime. But on the other hand, we can see our growth stocks crashing since February, rebound a little bit and continue going down and down and down, even though Nasdaq had been doing this and actually almost reaching the all-time high. But most of our growth stocks is still yet around 30 to 50% from the all-time high, if not more. Some of them could be 70% to 80% even. So we are seeing a big gap in between. So I think there are a few factors. Number one, a lot of growth stocks had this sharp fall in February and March, and it is most of them. And also happened to be what most retail investors were holding and buying during the run-up. And this is most of the retail investors. So during this fall, it had created a lot of panic. A lot of us had experienced an emotional roller coaster during these 2 months. From at first buying the dip, but then it just kept dropping, and then buying more, but it dropped further. And eventually, because of the fast and sharp dipping, may even eventually end up cutting loss at the bottom by panic selling. But with the big rebound, might get in the bull trap again, regretting selling in the first place and think, okay, this time I'm not gonna sell anymore. But then the share price just dropped more and not moving much. So it's a lot of emotional roller coaster for a lot of retail investors. And slowly, people are starting to lose hope and get very frustrated. And at this point, I don't think the government and the big institutions, the big capital, want everyone to lose faith in the stock market yet. So that's why someone is pulling up the FANG stock heavily to pull up the index to create the look that the stock market is growing well, while there are only the mega cap growing much and the volume is less and less. So we can see a lot of capital is still on the side waiting for signal to re-enter or endorsing the value stocks for the heated discussion and the high expectation of the recovery after the vaccine rolls out. So at least by pulling up the index, it can give more confidence to more people that the bull market is still here and we don't need to panic too much about the fluctuation and the bond yields rising. So this is like kind of giving out a call. And the second factor is Maybe I can use a metaphor of the housing market. You see, the red is the city center and it would be the highest price for the real estate. And then the yellow, the green, and the blue. So the red would be more like the FANG stocks. It would be the city center where it's the most expensive, the most popular. While the yellow would be like NVIDIA, Qualcomm. It's very good, but it's not as big as the mega cap. And then for the green, I would give example of Palantir or NEO. It's more medium caps, but quite popular. And then for the lighter blue, I will give example of NNDM or BNGO. It is popular small caps. And then for all the way out of town, the dark blue area, I would give example of something like EH, AQB, or LKCO, which less people would know about and quite small cap. So let's say right now there is a correction of the housing market. Where would it affect the most is of course the out-of-town area, because it is creating a lot of good deals in the city center. So I think at first the money would flow in the downtown area to grab those deals first. And once we don't see deals everywhere anymore at the downtown area, then the money would start to flow out to the surrounding area, the midtown, and then the outtown, etc. So for us right now, I think a lot of capitals are flowing in the FANG stocks because after a long consolidation for a while now, that the share price seemed to be a good deal and a lot of people have high expectation on their earning. The first quarter earning of 2021, they expect the earning to push the price up further, just like last year in 2020. So right now, that's why we still see money flowing in the FANG stock. And then once it's filled, we started to see more rises of good performance company like NVIDIA and Qualcomm technology as the next wave. And then next, we should see more money flowing into the popular medium caps, and then next, the popular smaller cap, and then the lesser known smaller caps. So this is how I see the sector rotate inside the tech stocks. Unless there are catalysts and good news for individual stocks, that would be a different story. And it is the same last year in 2020 when there was a big crash from the coronavirus. We also saw a lot of the FANG stocks get up on track first. It was rising all the way to September and peak at the correction, and basically went sideways until only recently. And this was when a lot of medium caps company grew stronger in the middle of the year, and then the smaller caps company grew stronger during the end of last year and beginning of this year. If we look at Nano Dimension, even though the market last year had bottomed in March, it did not stop dropping until later, and we saw it start to grow only by the end of September until the beginning of this year. And other hot stock, Jumia, the market bottomed in March and it was going sideways pretty much until June, even though a lot of the FANG stocks already grew quite strong. And it started to grow in July, went back down, so that was just a false breakout. And the real one came around the same time as Nano Dimension, the end of September, all the way to the beginning of this year. So we can see the popular smaller caps shared a similar cycle. And number 3 is that there are a lot of earning bomb for a lot of our growth stocks. Because recently we have seen a lot of selling off after the earning of the fourth quarter and the year of 2020. Like for example, YSG and ZEP share a similar pattern after the earning. And today we saw one of our stocks, JKS, had reported earning today, and in the morning it opened up dropping 10%. Even after being beaten down a lot lately, it dropped another 10% after the earning. I think just for this, a lot of people would want to sell out the other stocks that have not reported the earning yet. Like for example, EH, LKCO. A lot of the growth stocks had been hyped up over the past few months, but the earning kind of brought everybody back to reality. Especially 2020 was really one of the worst years for a lot of companies. Because of the coronavirus, for Z, it was stopping the export for a lot of months, and the sales still did not recover completely. And we know that for LKCO, it was also one of the worst years for them because a lot of the projects had been put on pause for quite a few months due to the coronavirus. So whenever they decided to give out the latest earning of 2020, we need to lower our expectation on that and do expect a time bomb potentially. But on the good side is that LKCO is already beaten down quite a lot already. And now for EH, I'm not surprised if people want to sell out before the earning. And that's why we have been seeing quite some sell-off recently. I think a lot of people are worried about the earning now and might choose to exit for safety and re-enter if the earning is good after. So that would explain some selling off recently. We can look at another example of Senseonics. Earning was on this date, reported quite a bit of the loss, just like JKS had been selling off since then, because the year of 2020 was also affecting their business a lot. So it would make sense for the capital to try to exit many of the growth stocks, especially the smaller caps, because they have the higher risk of bad earning for the year of 2020. Because the smaller the company is, the lower the ability of protection from risk. So that would be another factor to know why the capital is mainly pulling up the FANG and mega cap. And so many of the hot and popular smaller caps have been going downwards or going sideways and trading with such low volume. So what do we need to see our growth stocks back on track to grow? And when do we expect that to happen? For this, I think we need to look at a few indicators. First of all, we would need the Nasdaq to grow past the all-time high of 14,107.50. And we need it to pass beyond with the support of volume, because this would confirm that we are still in the bull market. And this is simply a correction, because as long as we have not passed the all-time high with volume, the index can still consolidate or backtest lower support, and we don't know how long it can be. So it would be important to see it passing the all-time high with volume to confirm the correction is over and we are still in the bull market. So then more capital waiting on the sideline would join in the party, just like what happened here in June. We have passed the all-time high before the coronavirus, and we saw the spike of volume here because it's confirmed that the crash was over. And then again in early February, we saw that it passed the all-time high here with spike of volume. And then we saw the volume had been growing since, because more and more capital at that time flow in the stock market, and actually came from a lot of other countries as well, because it was confirmed the correction was over and we were still in the bull market run. So that's the first indicator we need to see, the Nasdaq breaking all-time high with volume. So then the money would start flowing in and fill in the markets like the real estate map, step by steps. And the second indicator is the Russell 2000 ETF. We also needed to break through the all-time high with volume, unlike this here, breaking out with very little volume. So that was acting like a false breakout. And now, because the Russell 2000 is mostly consolidating and might need some time to consolidate, so our stocks would need to wait. And don't be surprised if you see it up and down day by day, up one day and down one day. And for our Chinese stocks, we also need to look at the Hang Seng Index and the Shanghai Index. For the Hong Kong market, we have been seeing red one day, green another day, and then red again, and green again, and red again. So one day up, one day down, because it's still under the pressure from the resistance, because a lot of people got trapped at the top here and here. So it would also need some time to consolidate on the side before breaking it through. For the Hang Seng Index, I still see room to grow. It has quite some room from the February high of 31,000. And if we zoom out, we can see that it has not even broken through the all-time high, which was back in 2018 yet, when in the US stock market it was greatly affected by the trade war from US to China. But the US stock market had recovered from it long time ago already, and not the Asian market yet. So in the long run, it still has room to grow, and for now we needed to finish consolidating on the side before breaking out. So that would affect many of our Chinese stocks as well. And number 4 indicator would be the quarter earnings from the mega cap stocks, because a lot of people are expecting the earning and then set the standard of the price for stocks. So we would know whether the stock market is too expensive right now. Because if the mega cap tech stocks is leading the growth of tech stocks, and if their earning is good enough, it would lower their PE ratio. It means the share price can still have room to grow, and it means the index can still grow. So I think a lot of people are waiting for this as well, to know whether the stock market right now is too expensive, to know whether we are in a bubble. So this would happen within a few weeks. So we should know by then. So I think if after the earning of the mega cap and they happen to beat estimates and lower the PE ratio, I think we can still expect a bull run. Meanwhile, the Russell 2000 and the Asian market would finish more of the consolidation. And I would expect that would be the beginning of when we can see some of our growth stocks to start growing again. But if the earning is not good, I think we can expect to see longer, maybe months. I wouldn't be surprised. But for now, I think it's important that we stick with the growth stocks that have good fundamentals, and we have full confidence to trust the company to perform well in the future, and to trust the management to lead the company in the right direction. Because even if a lot of the growth stocks had been hyped up during the end of 2020 and the beginning of 2021, and the recent big crash of them just brought everybody back to reality. The good thing is that within the bull run, some of them did change their fundamentals. So at this moment, you might be getting more and more worried whether you have chased at the high and become a bag holder. But here's what I think, so you don't lose your complete faith yet. I think the good news is that some of the high growth stocks did improve their fundamental during the bull run for a few reasons. Number 1 is that a lot of them were smart enough to take full advantage of the bull run while the market was in a euphoria to raise capital. For example, Nano Dimension raised fund for a few times already, that I think they might have enough capital for a few years to run, or it would allow them to acquire other businesses to enhance their competitive advantage. And this factor is one of the most important factor. And the biggest concern from investors for a lot of high growth stocks that's not making profit yet, it would be whether they can still have enough cash to run and to survive. And it's a very good thing to know they have sufficient cash in balance. So during the last couple months, a lot of the small caps, especially the popular one, were smart enough to raise fund. So that's a good news for them. Number 2 is that a lot of the smaller caps have dropped below the analyst rating already. So it would make their price look more attractive to a lot of institutional investors. So I think it would be just a matter of time when the value grows back to the reasonable value. And there are a lot of them like this right now. And number 3 is that the reason why we chose these growth stocks to begin with was because we thought they were getting into the turning point of the industry. For example, the EV, the solar, the HD map, etc. Why they were in the turning point was because a lot of them would need other technology to grow, to be ready, and also the market, the consumer awareness, the infrastructure built. This is all the factors that some of the growth stocks need to go into the turning point of the high speed of growing. So if this is the case, then our mind should be more at ease. So take a look at your stocks in your portfolio, and if they have met these requirements, then I think you don't need to worry about it too much. What you're losing at the end of the day is your time. Let time does its job, and let the company you trust to grow the value back. When you invested in this stock, you needed to know whether you wanted to hold this long-term or short-term, and don't mix them up because it would make you very confused. When things go south, it's much better when you have this plan in the first place, because you have 100% trust in your long-term investment. That's why you decided to put it in the long-term list. And for the short term, it's important to have stop loss so you don't lose too much to a point that you have to hold it long-term. So that's what I want to bring to you, because I see a lot of people asking themselves the same question every day about when will their growth stocks grow. I hope my analysis has given you more information and more support for your investment decisions, so you can take the weekend and evaluate your portfolio. So leave me a comment to tell me what you think. Now, if you have enjoyed this video, please give me a big like and write me a great comment. And I will see you in my next video. That's it, guys. Hope you can find my videos helpful. Make sure you subscribe to my channel and give me a big like. Thank you.